Welcome to This Week in Money. I'm Jim Goddard. Today, Peter Schiff from Euro Pacific Capital on the disconnect between the economy, jobs, and investment. And John Kaiser from Kaiser Research warning about the zombies among us. We'll talk to Peter Schiff right after this.
Randy Elvis Frisky and his Las Vegas show band relive the movie music memories from Blue Hawaii to Viva Las Vegas, in Ladner, Chilliwack, Maple Ridge, Nanaimo, Victoria, Sydney, Courtenay, Campbell River, Surrey, Kelowna. Details at randyelvisfrisky.com. Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
My guest is Peter Schiff, CEO of Euro Pacific Capital. And you also have several books out there churning through the mist and helping people out. You've updated The Real Crash, and you have another publication coming up.
Well, The Real Crash, the revised edition, that's the one that's coming out next month. The one that just was released in December is the collector's edition of a book that I wrote with my brother, How an Economy Grows and Why It Crashes. So even if you've got the original, you really need to get the collector's edition. And if you don't have the original, then definitely make a point of getting that one. And the revised version of The Real Crash, which many people think is my best book, that's coming out next month and is updated with over 100 additional pages of information that has come out since the 2010 release of that book.
Yeah, and is this an e-book or the real deal or a combination of both?
No, well, it's both. Actually, The Real Class was 2012, the original. How an Economy Grows, the original, came out in 2010. But you can get definitely you want to get the bound book if you're going to get the collector's edition of How an Economy Grows. But you can get either book in audio book, you can get the Kindle version, or, the real thing.
Well, you've got all the bases covered. You're going to be in Vancouver as well, speaking at the Cambridge House Conference, the biggest resource conference in the world. What do you think is going to be the big message this year? It's been pretty tough for a lot of people.
Well, yeah, I'm going to stress that, resources are here. If you look at the resource economies, look at Canada, look at Australia, the currencies are getting pounded, jobs are being lost. Why? Because the resource sector, they believe the headlines. Everybody is convinced that, inflation is dead and buried, and that, prices are going to fall for natural resources and minerals, and therefore companies have this negative outlook, and so they're not investing, they're not mining, they're not exploring, and they're not hiring, or in fact they're laying people off. But I think that a lot of these, resource companies are going to be surprised by how much prices actually rise in the resource sector. And I think they could start rising as early as this year. So I think those that are writing the obituaries for this sector, they're doing it prematurely. So I think you're going to see a big turnaround, because this fantasy of this great robust recovery where the Federal Reserve and other central banks can dial back the stimulus and taper and shrink their balance sheets without upsetting this apple cart is wrong. We've got a phony economy, completely addicted and dependent on ever-increasing doses of quantitative easing. And when the markets figure that out, it's going to be a huge turn in the fortunes of the dollar. Commodities are going to have a big move up, particularly the precious metals like gold and silver. And that's obviously going to, be good news for those sectors and the people who, work in those sectors.
We're talking about what are we going to do in the future if things are looking kind of rocky right now. Do you project 3, 4, 5 years down the road about where we'll be, or is that even possible nowadays?
Well, you can't project with certainty exactly where you're going to be, but, I think that, 5 years is a long enough time frame. Hopefully, we're starting to recover by then. Hopefully, maybe we've learned our lesson, but between now and 5 years from now, we're going to go through a massive economic collapse in the United States that's going to make, 2008 look like a Sunday school picnic. Hopefully, we're not still living through that depression 5 years from now. Hopefully, we'll finally learn from our mistakes and do something different. But if it's going to be more of the same, if it's going to be more of the same policies that we have, under Obama and Bernanke, then yeah, we're going to still be in a depression 5 years from now. Things will be really, really bad. And I don't think anybody's going to be talking recovery.
Everybody's talking about the damage that's being done to their pensions because interest rates are nothing. And so your pension manager might have to put you into something that's risky, or do they?
Well, there's a good chance that your pension manager already has you in something that's risky. I mean, you have to go take a look. But, we've got bubbles in the stock market. We've got bubbles in the real estate market. We've got bubbles in the bond market, bubbles in high-yield debt market. There's bubbles in collectibles and, in rare, in impressionist paintings and, pretty much everything but gold, and other resources, is in a bubble. And so, there's a good chance that if you've got your money managed by a third party that you're participating in one of these bubbles.
What happens when that bubble does a little jiggle and maybe loses some air?
Well, every time air starts to come out, the central banks are there blowing it back in. That's the problem. That's why we've had all this QE, right? Because they're afraid to let the bubble pop. I mean, we always talk about, too big to fail. Well, these bubbles are too big to pop. And the Fed knows it, so they're trying to do whatever they can to prevent them from popping. But in order to prevent them from popping, they have to make them bigger. And, that's how bubbles work. I mean, they keep expanding until they can't expand anymore, and then they pop. They don't just, stay at a, you don't inflate a bubble and then it just stays at that size. I mean, either it's inflating or it's popping. I mean, that's where you are. There's really no in between when it comes to bubbles. So the Fed is going to keep blowing air into this bubble until it bursts, because there's just too much air in it, right? If you keep blowing air into a balloon, it'll only expand so much, and then eventually the balloon's going to pop, and that's what's going to happen. The U.S. economy is going to have that kind of a big pop, and the air is going to come rushing out, and there's nothing they're going to be able to do about it.
Why is the economy tied to the stock market? Because the money being invested isn't being invested in the U.S. It's going overseas.
Well, it's not really the economy. I mean, the U.S. economy is weakening. I mean, if you look beneath the surface, if you look beneath the headlines of the record Dow and, rising real estate prices, if you actually look at the economy, right, the people that are working and producing, the economy is getting worse. The stock market's getting higher, but that's not the economy. But, and the GDP is growing, but does that really reflect the economy, or does that reflect excess debt, excess spending that is a function of these asset bubbles? The asset bubbles are getting bigger as the underlying economy is getting smaller. I mean, if you look at the growth in the stock market, it's not because of earnings. The earnings are barely going up. It's just inflated, multiples that are driving it. And a lot of the spending that's feeding through the GDP, that's borrowed money. And what are we spending? What are we buying? We're buying products made in other countries. I mean, so that doesn't reflect strength in our economy. That reflects the strength of the economies of the nations that produce the stuff that we borrowed the money to buy. So we're just going deeper and deeper into debt, and the people who are fixated on just the numbers and not looking beneath them to understand the dynamics, they're the ones that are fooled. They believe there's a genuine economic expansion when there's not. And of course, part of the problem is we look at the GDP and the government says, oh, it's up 3% or 2.5%, but that's only because they tell us that inflation is 1%. Well, what if they're lying? What if inflation isn't 1%? What if inflation is 4%, which is more likely than 1%? In fact, it's probably higher than 4%. But if inflation is 4%, then the economy is contracting. If inflation is 6%, well, we're in a depression, which makes more sense to me than the fact that we're actually growing, because all the anecdotal evidence, if you look at the U.S. labor force, is collapsing. The labor force participation rate is collapsing. The number of people on food stamps and disability is skyrocketing, right? So none of this makes sense with a growing economy. It does make sense for a depression.
Wow. So here we are on the depression bus, I guess.
Yeah, I think so we are. And, and it's not, it's not like your grandfather's depression where prices were coming down for consumer goods. Prices are going up. Food prices are going up. Gasoline prices are going up, rents are going up, utilities are going up, healthcare costs are going up. I mean, the cost of living is going up, and the government tells us that inflation is not high enough. I mean, that's really rubbing salt in the wound. We're suffering inflation, and then the government and the Federal Reserve come out and say, we don't have enough inflation, we need more.
And people on fixed incomes must be taking a hammering.
Oh, yeah. Well, of course, they have no income, and their costs are going up. So a lot of the people on the fixed incomes, they're gambling in the stock market. They're just hoping to make it on the come, because they can't make it conservatively. But, of course, when everybody is gambling, and what happens, then somebody craps out, and then that's it.
And of course, when you gamble, they're gambling that most of the people are going to lose.
Yeah, and of course the Federal Reserve knows that everybody is gambling, and therefore they have to, keep the bubble inflated. They can't let interest rates go up when everybody is levered up, and so they have to keep interest rates artificially low. That's why when they finally said that they would taper, buy, fewer treasuries, they had to marry that announcement with a commitment to keep interest rates at zero even longer than people thought, because they're so afraid of rates going up. Because we have so much debt. I mean, the highest rate we can afford is zero. If rates go up even to 2%, we're broke. I don't even know if we can afford 1%. But, that used to be low. When Alan Greenspan lowered interest rates to 1%, we thought that was low. Now that's high. This is the new normal. We have so much debt. We're so levered up. The U.S. economy is more leveraged in all aspects than it was prior to the bubble bursting in 2008. So what have we accomplished? Nothing. We dug ourselves into a deeper hole. We're even more dependent now on the very monetary policy that inflated the bubble that blew up in 2008. So now we got a bigger bubble, and when it blows up, it's going to be an even bigger disaster. And the problem is, there's nothing the Fed can do. There's no greater bubble to blow. The Fed is all in when it comes to stimulus and bubble blowing. So when this one pops, there's no bailout, there's nothing. There's just pain.
More with Peter Schiff next on This Week in Money.
Always consult your investment professional before making any investment decision. More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Peter Schiff, CEO of Euro Pacific Capital, and a person who is very worried about our immediate future because somebody on top of a hill with a big white building has been spending money like crazy, but is it real money?
Well, maybe that's the good news, that we're not spending real money, but it's doing a lot of real damage to the structure of the U.S. economy. And we are going to feel the pain. Again, when the monetary morphine wears off, that's when the pain is going to become acutely obvious to millions and millions of Americans. But right now, they're oblivious to it because, they're high. But, the effects of that are going to wear off. In fact, they're already beginning to wear off. We can see that. That's why I think the Fed, contrary to what everybody expects, is not about to reduce the amount of stimulus, but increase it.
How can they do that?
Easy. They just print more money and buy more bonds. That's all. Buy more treasuries. That's what they're going to do. They're going to crank it up. They're going to turn it up a notch. Just up the dosage.
So instead of tapering, they're going to do the opposite.
Yeah, exactly.
I don't know if it was you, but somebody said the official U.S. plan for dealing with the economic crisis is to spend their way out of it. But where does the money come from?
That? That's like somebody who's overweight saying he's gonna eat his way out of his obesity. I mean, no, you can't do that. That's how you got fat. You got to do the opposite. You got to go on a diet. I mean, so we spent and borrowed our way into this problem. We can't spend and borrow our way out, right? We got to do the opposite of what we did. But of course, they don't want to do that. They just want to double down on the policies that caused the problem and somehow hope that that's what's going to solve it.
Well, here in Canada, we have a government that's promising to give us a balanced budget in the near future and to pass legislation to make sure there's a balanced budget every year.
Well, at least they're promising that. I mean, we're not even promising that in the U.S. They're promising to give us deficits every year, But, politicians often promise to balance the budget, but the key is that they're actually delivering on those promises, because a lot of times they don't do it. But in America, people think that cutting the deficit is a bad thing. They want bigger deficits.
Here in Vancouver, they had the debt clock outside the stock exchange. And I remember when it was going up, and then it went backwards and went past zero and was in the plus until the recession hit. And they have done big cuts here in Canada. They closed the busiest Coast Guard base in Canada here in Vancouver. Tough cuts like that,
Cutting back on government spending is a good thing because that frees up those resources. The private sector can recover those resources and then utilize them, invest them in a much more efficient way to increase the standard of living of Canadians. So.
Bitcoins, are they the new tulip bulb?
Well, yeah, I think they're more likely the new tulips than they are the new gold, right? A lot of people are saying it's gold 2.0, and, I look at it more like, tulips 2.0. I understand, the frustration out there. People don't want to be in the dollar. They don't want to be in the euro or the yen. Everybody is printing too much money. And so they're looking for a private sector alternative. Well, the private sector has an alternative. It's gold, right? That's what was money before the government got involved. And the private sector also created paper money backed by gold currency. But what we have now in unbacked, currency, fiat currency, is a government invention, and it doesn't work. But in coming up with bitcoins, they're copying a lot of the problems of fiat money. I mean, they have some of the benefits of gold, but they don't have the most important one, and that is the actual value of the metal itself. Bitcoins have no value, and so, there's no way to really store value when they don't have any value to be stored, and they don't have any real use, and you have no way to relate a price in a Bitcoin. I mean, how much is a barrel of oil worth in Bitcoins? How much is a bushel of wheat in Bitcoins? How much Bitcoins do you need, to buy a suit of clothes or to buy a car, to buy a house? No one knows. I mean, so I think the whole thing is a bubble. People think that, well, they're scarce. There's only 21 million potentially. I think there's 12 million of them now or something like that. But there is nothing that stops somebody from copying Bitcoin. I can tomorrow launch my own digital currency. I could launch Schiff coins, and I can copy the entire Bitcoin, and so I can start mining Schiff coins. And they'd be identical to Bitcoins, except they'd have a different name. And there already are like 30 or 40 other digital currencies. Some of them actually are better than Bitcoin. The only difference is Bitcoin, got an earlier start, so more people use it. But so what? I mean, MySpace got started before Facebook. What good does that do them? It doesn't matter. I mean, ultimately, there's going to be a lot of competition for digital currencies. And I think when the bubbles start to burst and a lot of people start to lose a lot of money, where somebody let's say someone buys Bitcoins at $1,000 and all of a sudden, they wake up one morning and they're worth $100 and they've lost 90%. I mean, losing 90% of your savings really is going to, damage the reputation of a currency that could collapse so much. See, right now, it's popular because a lot of people got in real cheap and so they have a lot of profits. But when a lot of people get in high and the price goes down and you've got all kinds of people that have big losses, they're not going to be so enamored by Bitcoin. And, right now you've got a lot of merchants that are announcing that they're going to accept Bitcoin. And the Bitcoin community thinks, aha, this is, validating what we're saying. No, it doesn't, because the merchants are simply trying to tap into the wealth of the Bitcoin customer, because there are a lot of people now with Bitcoins that have a lot of money to spend. And so, obviously, if you've got something to sell, you want those customers. So what they are doing is they are accepting payment in Bitcoin. But they are not really accepting Bitcoins because they're not pricing their products in Bitcoins. They're pricing their products in dollars, and they're allowing you to give them Bitcoins only because they immediately take those Bitcoins and sell them to get dollars. So they're not really dealing in Bitcoin. They're just using Bitcoin as a payment method. But the problem is when people spend their Bitcoins at an online merchant, the online merchant immediately sells the Bitcoins into the market. So there needs to be a buyer for those Bitcoins because the merchant isn't a buyer. He's just a conduit. And so the problem is if a lot of people try to spend their Bitcoins at these merchants and then the merchants dump them on the market, who's going to buy them? If there's not enough new people coming into the chain letter, the bottom's going to drop out of the market. Right now most of the Bitcoins are being hoarded. People aren't spending them. But if more of these coins come into circulation, if you don't have, the greater fool out there to buy them, then, the market collapses, and that's what's going to happen.
Governments, at least China, really doesn't like the Bitcoin. They've banned it. Will that make any difference?
Well, they haven't banned it, but I think they are stopping financial institutions from getting involved. So it's not illegal for somebody in China to have Bitcoins and use Bitcoins, but the banks aren't using them, which makes it problematic because it makes it harder to convert your Bitcoin into renminbi. But, part of the problem for China is that they don't want Chinese using Bitcoin to circumvent their currency laws, their foreign exchange laws. So that's why they had to crack down on it. And of course, eventually, if the U.S. government perceives a threat in Bitcoin, if they think enough people are using Bitcoins, then they're going to crack down on it. The anti-money laundering laws are going to come into effect, and the government is going to make anybody who deals in Bitcoins collect Social Security numbers on the people who are using them and file reports, which will just increase the cost of accepting Bitcoins. And of course, companies will choose not to accept them because they don't want to bear those costs. Because remember, there are a lot of people that got Bitcoins very inexpensively. And if they now spend them, if they go to Overstock.com, which just started taking them, and they buy something, if you buy something for $1,000 on Overstock with a Bitcoin that you bought for 2 cents, 3 or 4 years ago, according to the IRS, that's $1,000 of income, right? Because it's income. And it's not even a capital gain because it wouldn't qualify for a capital gains tax. So it would be income because it's not really a security or something. So you'd have to pay ordinary income tax on it. Well, are people who bought Bitcoins cheap, who are spending them now, declaring it as income and paying taxes? I don't think so. So the IRS is going to want that money. They're going to want to crack down on tax evasion or money laundering, as they call it. So they're going to want the merchants to start filing 1099s, and now they're going to want the individuals who bought those Bitcoins to show what's their basis. What'd you pay for that Bitcoin? Pay income taxes on it. I mean, it's all a can of worms.
Well, basically, I think a lot of governments are treating it like you were trading shares and anything else. And the thing is,
I don't think they're treating it like shares because, it's not a security, but I mean, they're treating Bitcoin like any other commodity that you might buy. I mean, you can go online and buy a product, and so Bitcoin is that product, and really what you're doing when you're using Bitcoins to buy a different product, you're bartering. You're bartering Bitcoins for another product. But of course, the government will still look at a barter transaction, and impute income taxes if you gain on it. But they're not looking at it like it's a security. It's not, a stock or a bond, but it is a commodity that you purchase and you can sell it for a higher price, even if the sale is a barter transaction.
Well, apart from Bitcoin, are you still a big fan then of gold? Apparently, China
gold,
snapped it all up.
Yeah, gold is the real deal. Bitcoin is fool's gold, right? It's not the real thing. Now, I think that in the future, if you can marry the digital currency to gold and have a digital currency that's backed by gold, which is not difficult to do, that could catch on. Of course, the people who like Bitcoin say, well, that would, that would be a problem because now, the gold has to be somewhere. And they say that the benefit of Bitcoin is that it's decentralized and that, nobody has to hold any gold anywhere. That it's just, the Bitcoins just circulate around. So there's nothing for a government to seize. Although theoretically, they can come up with a way to seize the Bitcoin or they can go into the wallets and take them. And I know people will say, well, it's impossible. Nothing's impossible. This is all computers. What someone thinks is impossible today, somebody figures out a way around it tomorrow. Somebody might be able to counterfeit Bitcoins. I know they say it's impossible to counterfeit them. How do they know? Maybe based on what we know today, you can say, yes, it can't be done until somebody figures out how to do it. But in the end of the day, I don't even think it matters if you counterfeit them because you can replicate them. And, as Bitcoin prices go way up, you have more incentives for copycat people. People want to launch new digital currencies. They want to get to be millionaires. There are a lot of people now who put a few $100s in or a few $1,000s in who are millionaires. So other people want to do that, So they'll launch digital currencies. They say, well, I don't want to buy the Bitcoin. That's already $1,000. Let me buy this other one at 2 cents because maybe it'll be the next Bitcoin.
You're right. Let's publish the Schiff Goddard coin. I'm ready to do it. Peter, thanks a lot for chatting with us. Again, maybe remind people about your website.
Yeah, well, my brokerage firm, if you want to work with us on investing abroad in Canada, it's Europac.ca. In the U.S., it's Europac.net. I've got a brokerage firm, SchiffGold.com, for physical precious metals. If people are interested in offshore accounts, I have an offshore bank, EuroPacificBank.com, which does all sorts of things, including we offer gold and silver backed debit cards. So there's better than Bitcoin. You can have gold on deposit at my bank and then have a MasterCard that you could use to spend that gold. Anywhere that they take MasterCard, you can even take a cash advance out. So we've got that product. And if you want to listen to me, I do my own radio show 5 days a week, Monday through Friday, 10 a.m. to noon East Coast time on SchiffRadio.com. So if you can get up in the morning and listen to it, that's great. You can listen live. If you can't listen live, just go to SchiffRadio.com at any point during the day. You can hear the repeat broadcast. And if you want to be able to listen at your leisure to any of the episodes at any time, just become a premium member. Just sign up. There's a 30-day free trial, and then it's like $5 a month or something if you want to keep it. But it's SchiffRadio.com.
And if you register for free at that Cambridge House conference, you can hear and see Peter for free.
All right. Thanks for having me on.
After the break, John Kaiser on This Week in Money.
Randy Elvis Frisky and his Las Vegas show band relive the movie music memories from Blue Hawaii to Viva Las Vegas, in Ladner, Chilliwack, Maple Ridge, Nanaimo, Victoria, Sydney, Courtenay, Campbell River, Surrey, Kelowna. Details at randyelvisfrisky.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is John Kaiser of Kaiser Research Online. You can find his website at kaiserresearch.com. Welcome to the show, John.
Jim, it's a pleasure to be on the show.
Well, just talking to you before we went on the air, there's a deadline coming, and it could be deadly business for Canada's junior mining companies. What is that deadline, and why should we be so concerned about it?
Well, in April is the filing deadline for audited financials for juniors that have a December year end. And over half the juniors have December as a year end. And one of the startling figures that I've come up with based on all their latest quarterly financial filings is that there are 600 junior companies, most of them resource companies, which have negative working capital totaling $1.6 billion. This is money they've already spent and haven't paid. And the problem for these companies is an auditor, an accountant, cannot sign off on the financials if they are a creditor. And now these companies have to scramble to come up with money, probably to pay off last year's auditing fees, so that they can get their financials audited and avoid being suspended by the securities commissions for failure to file their annual financials.
And of course, the problem is if you have an accountant and you owe him money, well, this just throws you at the foot of the wolves.
That's right. So you have to reach into your own pocket if you're an insider or management, or run around to your friends and associates and see if they will loan you money, or even do a cheap private placement to put money into the treasury so that you can keep the company alive. However, many of these companies are just zombie companies. They have no real projects left. They are dropping projects left and right. They do not have a vision as to where to go from here. So it may be simply Darwinian survival system where these companies fade away and go away and leave the other 1,000 companies behind that do have a chance, that still have money, and could make a comeback because I do think the bear market downturn of the last 3 years has now bottomed, and we're facing a period where the better companies are going to start to trend up from the bottom. It'll be selective, and getting money into the treasuries of those companies that have real exploration plans is going to be critical. And there is a potential regulatory change which has radical implications for both retail investors and the resource juniors, as well as other junior venture capital companies listed on the TSX Venture Exchange.
And what is that radical change?
The securities commissions have proposed a prospectus exemption which would allow investors who do not qualify as accredited, in other words, they're not worth more than $1 million, excluding their residential home, to participate in private placements. And private placements have been the primary gateway by which the resource juniors have raised money during the past decade. Very little gets done in the short offering financings that the brokerage firms do, which are immediately free trading. Most gets done through private placements where the stock is restricted for 4 months and where there's usually a warrant attached as a sweetener that allows you to buy the stock for 1 or 2 years at a fixed price. The problem with the industry right now is the institutional capital has vacated it. Until gold is back in a major uptrend and other metals are trending up, that institutional capital will not come back. And the sophisticated investors, the ones that were over $1 million, worth $1 million, who put in most of the private placement money in the last decade, they are not putting any money in because they do not see an aftermarket for their stock. The retail audience, which used to sustain this sector, has been alienated during the past decade, marginalized, turned into a dumping ground for short sellers and existing shareholders, and now there are changes in the works which will allow the retail investor to come back in, not just as a buyer of other people's paper, but as a buyer of treasury stock that literally puts fuel into the tank of juniors where they like the story. The retail investor will become a collaborator in helping the company fulfill its goal of finding a new discovery or advancing an existing discovery.
What's the incentive to bring back the retail buyer?
Well, at the moment, the companies that owe the $1.6 billion, the 600 companies, which are 44% of the 1,400 TSX venture companies mainly involved in the resource sector, those companies are history. Nobody's going to give them any capital to pay money that's already been spent. These companies are going to do rollbacks, and then they're going to do debt settlements, give paper to all the accountants and lawyers and drill contractors and so on who are owed the money, and then they'll do another rollback and wipe them out. And these are just going to be zombie shells, which the stock exchange will eventually have to move to the NEX board or just plain kick off if they can't fix up the affairs. But what's interesting are the other 60% of the companies who still have money in the treasury, who are still doing stuff, but who do not have a lot of money in the treasury. And if you're spending money on exploration, you don't go from the drill program to an absolute discovery hole and a buyout in one shot. It gets done in stages. So these companies need a mechanism by which they can raise money to replace money they are spending and keep the story alive. And because the sophisticated people aren't interested right now, the retail investor who can make up to a $15,000 investment in a junior, you get enough of them together, you can get enough money for a program that could turn that drill target or showing into a new discovery, and all of a sudden you have some 10-cent stock that's at 40 cents, and the retail investor is suddenly making the kind of money that the sophisticated investors historically have done.
Is this an opportunity for what they call crowd investing?
It is a version of crowd funding, except it still involves the issue of treasury stock under the regulatory regime where the stock is restricted for 4 months. And the comment period, after it's over, they'll decide whether to leave it at $15,000, perhaps boost it up to $25,000. The reason they've got a cap in there is these stocks are high risk. And what they're always afraid of is that somebody who's got maybe a net worth of, $400,000 will go out there and get so pumped up by the story that the promoter is telling that they'll put, $200,000 into the stock. By having this limit, they force the retail investor to spread their bets, their high-risk, high-reward bets, around a number of companies. And I think that it's good to have a limitation like that because it is a statistics game. These are high-risk, high-reward companies.
Do they have some kind of regulatory thing for the regular stock markets? I'm thinking about people, throwing in all kinds of money to buy Google that's never made a profit in its life.
Well, that's what venture capital speculation is. These companies have zero or just modest revenues. They are startups in a sense. The typical life cycle of a junior is to generate the prospect, spend the money to see if the deposit is there, and if something significant is there, a major will eventually buy out the company and put up the big capital cost to put it into production. That is the general formula. And the Canadian Institution of Resource Juniors, it's been around for 100 years and has been very effective at raising this risk capital to find all these mines in Canada. And in the last 15 years, they have moved abroad into South America, into Africa, into Asia, and found all sorts of additional deposits. So it is a very important institution. It is what Canada is actually known for around the world. There isn't much else Canada is known for in which it excels, but the mining exploration and development sector is Canada's calling card around the world, and that is threatened by the potential collapse of the junior resource sector as a venture capital market.
Well, Canada is known for raising those funds. What about the Canadian Stock Exchange? Will that help things?
The CNSX it came into existence as an alternative for companies that wanted to do transactions that the TSX Venture Exchange did not allow. The reasons for fleeing the TSX Venture to the CNSX is a lower regulatory cost related to the listing and so on. But another reason to flee is not going to happen. There will still be short selling, elimination of the uptick rule. There'll still be fragmented order books where you can buy stock through different execution platforms and not know really what's going on. I don't see it as a meaningful solution. The proposal, as it's currently worded, excludes the CNSX, and that's probably inappropriate. They should include the CNSX because it is also a regulated exchange, and they do have to do CDR filings. So they are simply a competitor to the TSX Venture. But by itself, it's not going to make much of a difference because it is the need to get money into these treasuries from a much broader pool of investors than currently exists that is critical to keeping the sector alive.
More with John Kaiser next on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're talking to John Kaiser of Kaiser Research Online. You can find his website at KaiserResearch.com. John, well, now we've talked about the difficulty of raising money for exploration in Canada. If you're interested in investing in the mining sector, what should you do right now?
At the moment, the game that's emerging is that these companies which have advanced projects or are companies that are single mine companies such as Osisko, the bottom is in as far as the downtrend of the last 3 years, and now we're seeing the predators come out of the woodworks and make hostile bids for these companies at modest markups from these bottom prices. Osisko is an excellent example. It has the Malartic mine in production, nearly $2 billion invested. Gold has fallen back to $1,200. It's about $1,240.50 right now. It's not hugely profitable at these levels, which is why Goldcorp made a bid that's $2.6 billion for the company, which is a modest 20% or so markup from where the stock was trading. And what Goldcorp is counting on is investor fatigue in the Osisko shareholder base, that they will tender and that there will not be a competing bid from another major producer that wants a good long-term asset in Quebec. And of course, right now where gold is here, there is not much value in terms of the optionality of gold in the sense of, what if gold goes back to $1,600? Then this mine will be extremely profitable. So the big guys are now looking around to buy these assets that are being priced at $1,200, $1,300 gold, with the general outlook that we will see sideways or even lower gold prices over the next few years. And the Goldcorps of the world are happy to pay modest premium above sunk costs to own these assets and wait for the eventual resumption of an uptrend in the gold price.
Well, all the experts are telling us the equity markets in the U.S. have pretty well maxed out. Although you don't know when it's going to peak, it's close to the peak. And when it starts to slide, people will switch to gold again. So long-term investors are probably already looking at precious metals as the way to go.
Whether they're going to switch into gold, that's questionable. But we are seeing that the the diversified fund managers are looking at the resource sector as an extremely beaten up sector. And the general feeling is that the American economy will continue to improve. It will help out the global economy. We do see trouble in China, and there is concern that China may cave in upon itself.
John, thanks a lot for talking with us. Can you again maybe remind people where they can find more information about your research?
The website is kaiserresearch.com, and if you want to see more detail about my views on gold, there's a link called the Gold Resource Center. And if you want to see some of these graphics about the sad state of affairs in the Canadian junior resource sector, there's also a link to the Junior Resource Sector Crisis Center.
Thanks to our guests, Peter Schiff and John Kaiser, and thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.